It's time to find the optimal property strategy. In today's video, we're going to be discussing a whole host of property investing strategies, from high risk, high reward, to the slow and steady options that you can choose as a property investor. Everyone's going to take this property journey in a different way. You're not going to be able to buy the same properties that I buy and that clients buy and that other people buy. But we can look at different strategies that suit our risk profiles and our servicing, and talk about an optimal approach for most people to get the biggest rewards out of your property journey. Now, my name's Luke and I talk all things real estate, renovating, and financial freedom here on the YouTube channel. If you could like and subscribe and help us get to 100,000 subscribers, I think we're going to probably be the biggest subscribed YouTube property channel here in Australia, which is pretty exciting that we've had such rapid growth the last few months. So if you could hit that subscribe button for me, that'd be awesome. And let's just dive into these investing strategies and talk about them a bit further. All right, so let's take a look at these optimal property strategies, because we're looking to build some coin here. The purpose of building a property portfolio is to make money. We are investors, so let's have a look at all these strategies available to us. So on screen, we have a whole host of strategies here. We've got buy and hold, sell down, negative gearing, renovations, flipping, granny flats, subdivisions, unit blocks, and commercial. Now, a lot of these strategies I've done myself. So I'm going to be talking you through each of the strategies, and then we're going to be putting them on this scale between low to high risk, cash flow versus growth, and then we're going to take you through what I see as an optimal strategy for someone's journey. So the first one on our list is buy and hold. Now, I certainly have a bit of experience being a buy and hold investor. Emily and I started investing as a couple in 2018. And buy and hold is the base of most Australian investors' strategy here, because we're not making a short-term decision when you buy property. There's several percentage points when you buy a home in terms of fees and stamp duty, and there's always going to be costs associated with selling a home as well. So for most Australians, you want to buy a good quality asset with good growth potential and hold over the long term. So when we take a look at risk, it's definitely sitting on the low end of the risk, but it's going to be geared a little bit more towards growth rather than cash flow. So I'm going to put it in this quadrant here between low risk and growth, because that's where I really feel like it sits in terms of these options. Now we've got a bit of a sell down strategy, which is tied to the buy and hold. In these circumstances, it's about recycling capital. And a lot of buy and hold investors want to say buy and hold forever. But I myself have sold properties in the past and will continue to sell properties at strategic points in time to free up cash flow, to free up capital, to clear down some debt. I'm even looking at selling one of my assets in the next 12 months and buying other assets to recycle my capital into the right locations. Now, when we take a look at the quadrant on screen, I'm going to say that it is more growth focused, but we're moving into a more of a higher risk. It's definitely not cash flow. It's going to be leaning towards growth as well. So I would say that sell down is going to sit in the midpoint between low and high risk, because you're timing those markets. But because of the opportunity to recycle the capital and go again, I feel like it sits somewhere in the middle. Now, number 3 on our list is negative gearing. Now, negative gearing to me isn't a property strategy. It's a tax outcome. So I actually wanted to put this on today's list because it totally depends on how much capital you're willing to put into a deal. If you put down a 50% deposit, even on a property that doesn't turn over much cash flow, it doesn't actually yield very well, you can make it positively geared. Think about all the boomers that bought their homes for $50,000, $60,000, $100,000 30, 40 years ago. And now that home in Sydney, Brisbane, Melbourne, Perth, Adelaide is worth $600,000, $1 million, $2 million. Even if it's only getting a 2, 3, 4% gross yield, if you don't have a lot of debt attached to the property, it's going to be positively geared. On the flip side, for all those doctors, lawyers, accountants, high income earners in PAYG roles, negative gearing is the tax outcome. And I think it's one of the reasons Australia's property market is so prolific, because so many people want to get the tax benefits of being able to write down their day job income against their property losses from a cash flow point of view. But if you're getting growth on that asset base of 2, 3, 4, 5%, and those gains that you're making on the property are at a 50% CGT discount, that means that negative gearing can work for a lot of people. So although I think it's a tax outcome, I think we need it in our list of strategies here, because so many people are going to use negative gearing as part of their approach. Now, I actually feel like this is somewhere in the middle. I don't feel like it's high or low, or cash flow or growth focus. It's probably going to be more on the growth side, but you're losing cash flow as well when you do it. So it's definitely more growth focused, but I wouldn't even say it's high or low risk. It's totally dependent on the property. So I'm going to put that just right in the middle because I feel like it's not a strategy that fits into any of these quadrants. The next one I've got on the list is renovations. Now, renovations are something that I've done myself. I've done lots of renovations. I've actually renovated every property we've purchased because part of our strategy and Emily and my approach in building our property portfolio was to manufacture value. So to focus on manufacturing value to fast track our wealth creation, allow us to pull out equity faster. Now, if you're not going to manufacture value, you're reliant on the market moving, and you can chase hotspot locations, which is another option for a lot of people. But for me, renovating was almost going to guarantee it, as long as you bought the right property and you looked at the comparable sales, renovating was going to give you a great opportunity to force that value rather than waiting for the market to do something. So I certainly think renovations fall into that higher growth strategy, but definitely higher risk. So it's forcing some money into the property, but you're also having a higher risk profile for that position as well when you move into renovations. Flipping is taking a much shorter term horizon. So I did a flip project. We did the flip project on the north side of Brisbane in Aspley in 2023, and that was a sub 1 year turnaround time. So it was about 6 months end to end. Now, the difference between the flipping and renovations is that time frame. So for me, you're getting the benefit of the renovations, including the depreciation, the higher rental yield, the ability to refinance and pull out equity. Whereas flipping, you're looking to make cash on cash return in a very short time frame. Just given the cost of trades at the moment and given where things are at, I just think flipping is way too high risk and it's targeting a growth strategy. It's going to be somewhere in the middle here. I think it's very high risk, but somewhat growth focused. I don't think the risk is worth the reward, in my opinion. I'd much rather be renovating, which is, not as high a growth potential, but somewhat high risk. And then selling down is timing those markets. So I think those are better strategies than flipping. But yeah, if you want to do it, you've got to have the teams, the people, the resources available to you to take on those types of projects. The next one we've got on the list is a granny flat, which is a personal favorite of mine. I'm currently constructing one of my granny flats, looking at doing 2 more granny flat projects in the next 24 months myself. And we've helped tens of clients execute on granny flat deals and more clients in the pipeline, looking at their properties, making sure that they have the granny flat lever that they can pull down the track as part of their property strategy. Now, looking at the quadrant between risk and return and growth versus cash flow, granny flats are definitely going to be on the cash flow side. Now, as far as risk goes, I would say granny flats are right down the middle. They're neither going to be high risk or low risk. There's certainly some risk involved. I even drag them a little bit to the higher risk side, but they're going to be geared towards cash flow. Far less than growth. I would say they're right down the cash flow side because you're building an asset, you're not subdividing, you're reducing your buyer pool when you build a granny flat because you can only really sell to investors or people that want that secondary dwelling down the track or want those higher yields and returns and maybe live in the front home and rent out the back home. So that's where granny flats are going to suit the right person at the right point in time because they're going to give you that cash flow. You spend $200K and you get $400 a week return. 10 to 15%, you can see big returns on those types of granny flats. The next one we've got is subdivisions. Now, this is clearly a high risk, high growth strategy. So I'm putting that right in the top right corner, but the returns are potentially there. I've heard of people making $1, $2, $2.5 million on one project from subdivisions. The problem is there are so many complexities with those subdivisions. Yes, it's very high growth, high return, but you need a lot of capital, a lot of knowledge, and you're relying on a lot of experts to help you in that journey. That's one of the things I don't like about subdivisions. There is complexity with every site, and depending on which statistics you look at, around 90% of subdivisions or developments potentially lose money. So a lot of developments and developers lose money, and mums and dads lose money in developments, whether they're investing in an SMSF into a syndicate or they're taking on the subdivisions themselves. I'm not a huge fan of subdivisions because of that super high risk profile. Yes, you can make crazy returns. Your timeline for 1 to 2 years, you can make 200, 500%, huge amount of returns on your money depending on how you structure and finance the deals. But yeah, that high risk, high reward, probably not going to suit me, but that's where I think it sits in this quadrant between cash flow growth and low and high risk. Now, unit blocks, definitely more of a cash flow strategy overall. And it depends on the unit block. Are you constructing it? Are you buying it pre-existing? I would tend to say that they can be a bit more growth focused because you can strata title the unit blocks. But it's probably a little bit higher risk than kind of a granny flat strategy. You definitely need to be a bit more advanced as an investor to take on a unit block approach. So I'm going to put unit blocks on the slightly higher risk end, bit of growth, not so much, more cash flow focused overall. I own a unit block myself in a regional location called Coffs Harbour, which is located in the mid-north New South Wales region. And the reason I bought that unit block was to be a bit more cash flow focused. It was to take on a bit more risk, and I'm not going to look at strata titling my unit block, for example, because it is more of a cash flow, single title, buy and hold play. The thing you need to understand when you're taking on a unit block approach is that there's more, you got more headaches, you got more air cons, more kitchens, more bathrooms. There's just more work overall. Council want more fees for the land size. Financing can be a bit of an issue. You need larger deposits. They're generally seen as a commercial property. So with unit blocks, I think you just need to be aware, overall that they can be the right property for the right buyer at the right time, but they're not going to suit everyone's overall approach and strategy. Unit blocks, you need to be sensible with the way you find the block. Make sure you don't overpay. I've seen a lot of people pay a lot of money for unit blocks because they're going for more growth approaches. But generally, when you're buying unit blocks, you're looking for a little bit more cash flow, taking on a little bit more risk, and you understand how the banks and brokers are going to work in terms of that approach and how that unit block fits into your overall portfolio. The final one I've got on my list today is commercial. Now, there's so many types of commercial. You've got office spaces, you've got industrial, you've got retail. So it's not very fair to put commercial under strategies here because there's a whole ton of sub-strategies. Like there's a lot more strategies than residential that we could put on this graph today, but we've got to keep it to a certain list. So commercial, I think, falls outside of the realm for most investors in this space. Commercial people are generally looking for those cash flow returns, but it's going to be on the higher risk. But commercial can return capital growth as well. So I actually feel like commercial is going to sit around here in the higher risk, but somewhat growth and somewhat cash flow driven. I actually feel like commercial was going to give you potentially more growth than unit blocks. Yes, it might be slightly higher risk, but you can also get more cash flow as well. So I'm going to put it right around that midpoint between growth and cash flow, and on the higher end of the risk scale from my general point of view, because commercial tends to be another ballpark. Not many people start in commercial because you need a lot more capital. Again, similar to the unit blocks, you're going to need 30% deposits plus closing costs. So if you're looking to buy a big retail precinct, 3, 4, 5 million, you might need $1 to $4 million of cash to make sure you can fund that deal. And if you really want strong cash flows, you're going to need to make sure that you buy in the right location. So I think the location is going to determine for a lot of these different strategies whether it's more growth or cash flow, because you could buy a cheapie in a regional and that could be more cash flow driven, or you could buy a blue chip 1 to 5 kilometers from the CBD property and that could be more growth focused. But generally commercial is going to be that higher risk approach, somewhat cash flow driven as well, somewhat growth driven, depending on the style of asset and property that you buy. So what a mess. We've got property strategies all over the place between growth, cash flow, low and high risk. But the thing is, properties can fulfill multiple options. Properties can fulfill multiple facets. You can have a buy and hold that you also do a granny flat on. And once you've built that granny flat, you could also renovate the front home. And then you could go and sell down that property to then go and buy a property that's in the commercial space or fund a unit block. And so this is where these property strategies are somewhat obsolete, because one property can take you on that journey from buy and hold into a reno, into a granny flat, and then you can get into a unit block, and then you can get into a commercial. So it's actually all intertwined. And this is why property investing is a journey. And so on screen here, this is kind of Emily and my journey the last, half decade. So you can see in the timeline, we got married in 2016 here. And then in 2017, we're saving our pennies. 2018, we buy our first property. Now, that first property is, if we go back to this slide here, that first property is a buy and hold. We've held that now for coming on seven years, 8 years. So it was always intended to be a buy hold, and we might sell that property in the next 12 months. I might sell that property, I should say, because Emily's no longer with us, unfortunately. But the reason Emily and I bought that was a buy and hold, but it was also a renovation. And there's no other strategies on there. But then we're going to look to sell down and recycle the capital on that deal specifically. So that's where that 2018 deal might be a different story in 2025 for me. And then in 2019, we've renovated that property. So that's where the reno comes in. In 2020, we're buying some more growth assets. So we go back, we buy some more buy and holds. We again renovate to add value and fast track that process. So you can see very quickly that we can stack these strategies. And that's what I've called it in the past, a stacker strategy approach. Between that list of strategies that we started with, you don't have to tie yourself to one approach. You don't have to be positively or negatively geared. You don't have to be all in on high risk or all in on low risk. You can find the right deals at the right point in time. And for most everyday Australians, it's going to be about building the property portfolio. And that's where a lot of people get stuck. So in our case, we started with our first property. We broke into the market in 2018. We then moved through and renovated that home. We've then bought 2 more properties with the serviceability, going back to CBA, getting access to the cash. Then we've gone and bought that unit block in 2021. We've started our family in 2022 with our young son, Asa, our eldest boy. We did the flip project, which was a mistake in my opinion, in 2023. And then we're moving through to 2024. The family's grown. We've had Eli be born late in 2023. We're selling down some of the assets. And now I'm looking forward into the future. What does 2025 look like for me? What does 2026, 2027, 2028? In my opinion, it's about using all of these strategies to optimize your approach. So for me, most people are going to start with growth first, cash flow second. If you've watched any of my videos, you've probably heard me say that tens, if not hundreds of times. And so that's why I think most everyday Australians are going to start with the basic buy and hold and build out that property portfolio approach. Once you've got between 1 to 3 properties under your belt, ideally you're buying properties with the ability to add value, with the ability to come back and add a granny flat, or even in some clients' cases, with the ability to subdivide in the right circumstances. Then after you've got 2, 3 properties under your belt, you can then look at a sell down approach. You can recycle your capital, move into markets that make sense for your investing approach and your investing strategy. And then maybe you're looking like Emily and I did to buy a unit block or to move into the commercial space. Now you've got a bit more capital. And then you can look to add granny flats and start your developments. So to me, that's the optimal approach. It's using all of these strategies available to you at the right points in time. I've had some very interesting free strategy sessions and strategy sessions with clients recently, looking at higher income earners in the family and lower income earners. This is going to be a huge tip for you if one of you in your family, in your household, maybe the husband's earning 200,000, the wife's earning 80,000. Can we get a situation where the husband owns properties and is getting all the negative gearing benefits and the wife is getting all the trust structure distributions and that property holds less debt? Go back and rewind that, because that could be a huge tip to you saving thousands and tens of thousands in your tax planning. We can also then look at land tax planning. So there's so many 1%ers that you need to look at across your entire property portfolio to get yourself the optimal overall strategy. Now, my optimal strategy that I'm currently executing on is not the same as yours. And it's not going to be the same as anyone else's story that you hear on podcasts or read in books. Your journey is your own. And so you need to look at your own serviceability, your own savings, your own properties in your current portfolio, and how you can take that next step. Now, if you've decided that Brisbane or Southeast Queensland is a place that you might want to buy, and you're looking at maybe a mid to long-term approach, but also these other optimizing strategies and structuring, financing, maybe granny flats, maybe renovations, myself and the team at Purpose Property are here serving the Southeast Queensland market for people who want to buy and use our buyer's agency services in the next 3 to 6 months. So if you want to sit down with myself, head over to purposeproperty.com.au and we can sit down together and go through in a half-hour session talking through this overarching strategy and what your next steps might look like. And if you're buying anywhere across Australia and you want to see exactly how to build a multi-million-dollar property portfolio, you can head over to purposeproperty.com.au and click on course. And for anyone watching this video this far through, we still might have a discount code, which is 20% off. So type in TWENTY 20 And I think there still might be a few codes left. So if you're quick, you might be able to get 20% off our Invest with Purpose course as well. I'd love to hear your thoughts and comments down below because there's so much talk and chatter about the optimal property strategies at this point in time in Australia. And I feel like we're at a tipping point in this time in the Australian property market where the property market can be running away from people in the next 3, 4, 5 years. So taking action and making these decisions could be critical to your future and your family's future to give yourself more choices. So leave a comment down below and give this video a click over here because YouTube really thinks you'll like that one. So I'll see you in the next one. Peace.